Hello, everyone, and thank you for listening to our podcast. Tiffany and I give our all to this podcast with curating information, researching platforms, and creating a show with the best up to date information we can. We have a vested interest in the growth and health of your business and hope you feel the same way about us. Want to produce a show?
You know you do.
Yeah. All you have to do is email us at thebusinessbehindsmallbusiness@gmail.com to express your interest, and we will share with you what you'll receive with your investment. You'll have the opportunity to have your name and the name of your business mentioned multiple times during our show, have your company logo on our social media, of which we are on LinkedIn, Instagram, and TikTok. And along with that, you will also have an opportunity to share how to get in touch with you and other marketing opportunities as well. Please support us so that we can continue supporting you. Welcome to the business behind small business. Whether you're selling or staying, we're here to remind you that just because you own a business doesn't mean you are a business owner. We are your hosts, Sevana Stone and
Tiffany KO.
And we're going to get down into the nitty gritty to walk you through the more finite details of entrepreneurship, revealing the dots between startup and success. No one gets to 1 million without getting a little dirty. There's a lot of business behind small business, so let's get to it.
Well done.
Yeah, thank you. All right. So we're going to be talking about all the ways in which your company can get a loan or a grant or aid. Today, we're going to be focusing more on loans. And we're going to talk about what you need to take into consideration about the different kinds of loans and what to avoid and just best business practice. Even if you're not needing a loan just yet, you still don't want to be scrambling last minute. So before we begin, please note our disclaimer. This is available in both our show notes and on our website and should be referred to before and or after this podcast.
So I think all businesses at some point typically get to a point where they need more capital. They need an infusion of cash. And I think a lot of people shy away from that. I did with my first business because I was like, I am not smart enough to figure this one out. I should not be responsible for taking on debt. But in the future, I think I would be pretty open to it because I think once you understand it and you know how to manage it, then you can kind of use it for good.
Absolutely. And a lot of times it might not be a matter of you needing cash flow or rather help with cash flow. Maybe you have an idea and you don't want to invest your company's money into it. And it might be a better idea to get a small loan to take you to that next level.
Yeah, absolutely.
So it's not always about needing money.
No, I see it more of like it's an acceleration to expand, to grow and to expand. And when you get to a point in your business where you can think about that, it's very exciting, but it can also be really daunting if you don't understand the different type of loans that are out there and what you need to prepare for. Because typically it's not, I need a loan today. I'm going to go walk down to the bank or some lender and I'm just going to ask and I'll answer some questions and they'll give me a loan.
Please, sir, may I have some money?
No, right? So by the time you need it, you're probably already a bit behind on preparing for it, right? So you don't want to wait till you absolutely need the money and then realize that you weren't prepared and then you get a very nice earful from the lender who are like, maybe just, there's a few things you need to work out. And, before you know it, you kind of end up pushing back your goal. You can't expand as fast as you would like because you simply just wasn't ready when you get there. So we are here today to talk about those different type of loans and then what you need to do to actually prepare for the loans. And like Sevana was saying, also things you should not do. So you guys will be well prepared.
Yes.
All right, so let's talk about the different type of loans. There are a lot of common loan options for small businesses out there. So we're going to quickly run through it so everybody kind of understands what the options are. Now, these are only a few products. There are a lot of ways to raise capital, but again, we're kind of focusing on more of the lender-lendee kind of relationship in this case. So we're not going to talk about investment like fundraising and all that stuff.
Yeah, not in this episode.
Yeah, that's a whole different, that's a whole different ballgame there. So common loan options, right? So we have the term loans. Term loans means that you have a lump sum of money that you pay back with interest over a set period of time. These are term loans are very popular with traditional banks, with credit banks. There are now online lenders that will actually give you these term loans. And mostly the metric that they're looking for from you to decide whether or not you should be given a loan by them is your credit score and what's called a debt service coverage ratio, which means that they'll give you a nice fancy calculation you have to do, and you need to pass that.
Yep.
And we'll kind of dive into this a little bit more. But one of the themes that our listeners are going to hear today is how important your financial statements are when you're going to ask for money. And one of the things is the debt service coverage ratio. All that information comes from your financials. All right. The second type of loan is SBA loans. So a lot of people have heard about this, the SBA, Small Business Administration. It's basically government guaranteed loans set aside for small businesses. And there are certain banks, actually a lot of banks, but there are select banks, not every bank, are able to provide SBA loans. Credit unions can do it too. And there's also, these specialized SBA lenders out there that what they do is can help facilitate these loans. And very much similar to like the term loans, they want to look at your credit score and they want to look at your debt service. Now, there's also the business line of credit, right? So people can apply for this. And the cool thing about this is that it's very much flexible borrowing. So it depends on when you need it. So once you qualify, you can have access to this this set amount of money, and you get to pull it out or pull on the line whenever you need it, and then you pay the interest and you pay the principal back at that time. And then if you don't take anything out, then there's nothing to pay, but you kind of just have access to it, which is why it's so flexible. And banks are big at on doing these, and certainly there are, like I said, online lenders now that do all these. And for the line of credit, of course they look at your credit score, but they also look at really your business cash flow because, hey, they want to know if you'll be able to pay them back.
Yeah.
The other type of loan option is equipment financing. And so these are loans basically used to actually purchase equipment, and you use that equipment you purchase as the collateral for the loan. Now, banks do this quite a bit. There are very specialized people out there that do these as well, just depending on what type of business that you have. So if it's very heavy in equipment, then this is something that there are specialized lenders in certain, like for these industries to kind of help facilitate that debt for you. For this, as you would imagine, a lot of it has to do with the value of that equipment you're buying. That's the collateral that you're using, kind of guaranteeing that you're going to pay this loan back. Otherwise, they own the equipment. Yeah. Right. So the value of the equipment has a lot to do with how much financing you're going to get. And again, this goes back to the whole debt service coverage as well. And then last but not least, we have invoice financing, also known as factoring. So this is where you basically kind of sell your invoices that are unpaid by your customer to a different company who will pay you cash now. And then the customer, when they pay, they actually end up paying that company, your lender, back. So you kind of get access to the cash a lot faster. So like say, for example, your customers have a 30 or 45 day payment term. So you issue an invoice on the 1st, they don't have to pay it for 45 days later, but you need the cash in 15 days. So what you can do is you can go sell that invoice to a lender who's willing to buy it from you at a discount for a fee, of course, right? But the idea is the fact that maybe out of that $10,000 invoice, they're willing to finance you $88,000 right away. And so you get the money a lot quicker, pay off what you need to pay off. And then when the customer pays the full $10,000 invoice, the lender gets their cut of fees, and then everything's all square again.
How does that relate to a debt collector? Is it invoice financing and debt collection kind of the same thing?
What do you mean debt collector?
Like somebody who is, like say I'm sending you to collections. How is it this? Is it the same?
It's not the same. So there's no disruption. There's no connection. There's no like contacting those customers. So a lot of times those customers may or may not even know that you're factoring. It depends like how it's set up. So there's two ways. Either the less common way is the customer actually pays you, and then you in turn pay the lender. But typically when it comes to factoring, and by the way, this is something that's done quite a bit, so it's not really so much out there. But if it's factoring, then a lot of times the customer pays the factoring company, and then the factoring company will take their cut of it and then pay themselves back, because obviously they fronted the money to you already. Yeah.
Okay. All right.
But they don't really contact your customers otherwise than that. There is no you have to pay right away, however. But That being said, before you get that loan, I mean, one of the things they're going to do is they're going to look at your accounts receivable and see how good it is that your customer are going to pay you, right? So if your customers are usually always on time, it kind of mitigates their risk. And so it's not that like these customers they're going to allow these customers to run off and not pay you for 90 days now that you're factoring.
That's true.
By any means. No, that is no. Okay, so now that we know about the different types of loans, and again, these are the more common loans that's being used, let's talk about what are the items that you typically have to prepare internally before you go to a lender to apply for one of these loans. So with a term loan, typically the lender wants to see your business plan. That's right. They actually want to know kind of what you do, how you do it, how competitive are you, and what are your projections for your business. So what's your growth projections? The other things they probably will look at is your personal and your business credit reports. Okay. Then they want to see your financial statements. I feel like this episode we have to play a drinking game out of financials instead of process, because that's the word we're going to be using a lot. They also want to see your tax returns. So typically for both the financial statements and the tax return, they actually want to see 2 to 3 years in the past, right? So it's not this year, it's not last year, but it's also the year before. So just kind of think about that, right? Because you want to make sure that all 3 of those years look good and hopefully you're trending up. They also want to see your list of business owners and ownership percentages. So if it's not just you, then typically they want to know who's also involved in the company and how much they own of it. They're also going to look at your loan application history, meaning they want to know who else are you borrowing money from. Last but not least, they take a look at your business license and your registration. They want to make sure that you're all set up and all the paperwork is done, and you're also a company in good standing, right? So meaning that you paid all your, little fees and everything you need to pay to your accounting and state. And then last but not least, they want your personal financial statement. And the reason being is that a lot of loans oftentimes comes with a personal guarantee. And personal guarantees means that you as the owner oftentimes are asked to personally guarantee the loan, or somebody else, if for some reason the creditworthiness of your business and of yourself isn't enough to actually make them feel comfortable that they can lend you this money and there's a high percentage that you will pay it back. And so the personal financial statements is actually quite detailed. It will go over just all of your personal assets, all of your liabilities, and usually it's not just you. If you're doing it as a company, typically your partners all have to provide personal financial statement. Yeah, so it's quite a bit of pay work.
I mean, they want to make sure they're getting paid.
Yeah, I mean, all of it is just to ensure that they're going to get their money back. Right. For SBA loans, you kind of go through similar information. It's just filled out on fancy government forms, as you would imagine. So it's the same idea, right? You still got to provide financials. You still got to provide your personal and business financials. You also need to provide a list of where else you're borrowing money from, what other liabilities and debts you have. You got to give an overview and history, which is kind of similar to your business plan. Who you are, where you've been, what you're working on. Have you ever financed with the government before? How did that go? And then they'll ask for like resumes for all of the business owners. Now, next, line of credit. So with the line of credit, again, with the lenders, they're looking for tax returns. The key being 2 to 3 years tax returns.
It's always 2 to 3
2
years.
to 3 years. That's what we were saying is by the time you think about going, you may be a little bit behind preparing, because sometimes people don't think about what the last 2 to 3 years look like. And maybe you've worked really hard, but that 2 years ago, it was kind of a crapshoot.
Yeah.
Right? It does impact what you're able to do now. So that's why we say it's a good idea to think about this ahead of time. But same thing, tax returns and financial statements for the last 2 to 3 years. Of course, the lender wants to know where else you're getting money from, and then your personal credit score. Yeah. And that's the other thing too. I think people are very surprised that they're asked for their personal credit score, because they think it's all business related. So they must be only wanting to know my business. And no, they do want to know your personal credit score. Yeah, because in the end, they want to make sure that you, the person, are going to be able to pay it back. And if you don't have a good history of paying things back, chances are they're not going to give you money. Yeah, chances are you're not going to be good about it in your business either, right? So it says a lot about that there. Equipment financing. So in this case, it comes down to seeing the equipment quote or invoice of how much this equipment's going to cost. And they actually need a legitimate quote in an invoice, right? So it's not a promise or a website. This is what I hope to buy.
Yeah.
This is how much they're quoting it for at retail. Can I get funded for that amount? No, it doesn't quite work that way. There's the business credit report, like we have said. Again, going back to financials, tax returns for 2 to 3 years. And then like anything else, they want to know who owns the business, how much percentage, so all the ownership information.
Mm-hmm.
And then last but not least is invoice financing. So this is the factoring we were talking about. And so for this, it's a little different because they're basing their loan on your accounts receivable.
Mm-hmm.
So they want to see a list of all your outstanding invoices that you want to finance for. And then they are actually going to check the credit worthiness of your customers.
Mm-hmm.
Like we were talking about, if they look at it and they're like, oh, this customer is constantly late and they're always paying 90 days instead of 30 days. Yeah, they're probably not going to loan you money on that because they're not going to want to chase down those customers to get themselves paid, right? Because remember, they're fronting you the money now and they're waiting on the back end to collect from your customers.
I would say that's probably something a construction company or somebody who's creating something for a client that has to pay in installments. And then let's say you would really like, let's say, I don't know, you have 50,000, the person's paid in increments of 50,000 up to this point, but you kind of really need that 50,000 right now. You know, they're going to be good for it, but you kind of need it right now anyway. That would be the right kind of, I think, invoice financing you might want to do. If you've got something that is $50,000 and you have not been able to get a payment out of this person ever,
you're probably not going to get financed based on that.
That's when a debt collector would be a better option.
Well, that would be that wouldn't even be financing as much as just collections, right?
Yeah.
That's not getting a loan or lender or interest or anything like that, like in that sense. You're not even getting it up front, right? Because then you got to wait for the debt collector to actually get to the person to get the money paid. So, but a lot of government contractors use finance. Accounts receivable financing, solely for the purpose of, it's not like they're in trouble by any means, but there's a very long period of time before they get their payment for work that's already done, because there's just a lot of process procedures on how you invoice the government. And let's just say, for example, you don't get paid until like 90 days after the work is done. Oh, that's not that long. 30 to 60 is probably like the normal time period to get paid. But look, your people's been doing work. They're on your payroll. So they probably want to be paid every 2 weeks. So you got to be able to make that cash work. And this type of option is super common and very popular in the government contracting world, because as you would imagine, the government is actually fairly on time with their payments. So lenders are much more willing to kind of get into this game because they're going to get paid back.
Right.
And then on top of that, just, all your formation documents and then of your banking information so that you can actually apply for invoice financing.
Mm-hmm. And so I'm going to drill a little deeper into what kind of steps you need to take before you apply for a business loan. Know that you have options, just as Tiffany mentioned. So you're going to want to apply with the right lender for you and choose the right business loan for you. Even though you have all of these options that she mentioned, maybe not all of them are right for you. It could be a personality thing or it could be a situational thing. Either way, you got to research your loan options, and there should be opportunities for loans within your city, your county, your state. So you have options outside of the bank alone. Although large banks can fund significant loans, loan alternative lenders could give you quicker approvals and may have less stringent funding requirements. If the amount you need is not a ginormous amount, you may have more luck with an alternative loan opportunity. I had to say that first.
Alternative loan opportunity.
Yes. So I'm going to get into
that. Well, let's just say that, and oh my gosh, I hope all the banks don't jump us at once, but banks are typically a little bit more conservative, right? Because they also have a lot more
it makes sense.
Compliance, right? And so they're a little bit more conservative. So I would say that on average, it's very rare for a business under 2 years old to be able to get substantial funding from a bank, because you just haven't established yourself yet. And so that's not your fault. Like you're just starting. You can't help how long you've been in business for. And that's when all these, what was
private
alternative,
equity,
alternative lending,
alternative lenders,
alternative lenders. Sorry, I forgot what you said, and I was like, alternative lending options. Can step in.
Yes, of course, you're going to want to be able to maintain good credit, regardless of how long you've been in business. Just as you would with any other kind of credit card, a mortgage, or car note. Lenders are going to want to know what your experience in the industry is, and they're going to want to know how long your company has been in business and what your reputation is. If your business is pretty new, as you said, a bank may be less likely to approve your loan. If you have a terrible reputation and you prove on paper that you are not great about paying people back, I'm sorry to say your lender will be less likely to give you money. It seems pretty elementary, but the truth of the matter is that they want to make sure that if they're going to loan you money, that you can pay it back.
Yes. And I want to say, I almost want to say that the interest rate is also directly correlated with that.
Absolutely, it is, because the interest rate is going to be correlated to how much risk is involved in this. I also understand that it's easier said than done to have clean and well organized documents. It is something that we harp on all the time, but I do understand that not everybody is great at that.
And we also say that too because a lot of companies don't know 2-3 years down the road they're going to go get a loan. They don't know what their circumstance is.
Totally.
It's a lot harder. You can't change time, so you can't go back really to recreate it. So if you just keep up with it, you'll be prepared when you need it.
It is well worth your time, maybe your free time, or just create some time to organize. Find time to organize your documents to show how well you track your assets, your revenue, your debt, and your expenses. You're also going to want to have a proof of cash flow and accurate financial projections. There should be a realistic forecast of your company's future financials because, again, lenders want to know that you're going to be responsible with their money. If you have absolutely zippo zero time in order to do such a thing, then carve out some money. You'll have to tighten your belt a lot and have somebody else do it, like a bookkeeper or an accountant. This is going to help you in the long run because then you'll have a better idea of how much your company needs to get you to your next level. If you ask for too much, you're going to wind up paying unnecessary accumulated interest. And if you ask for too little, you're going to have to apply for an additional loan, and that's going to come with its own interest and payment plan, which in the long run may end up costing you more than it's worth. Once you've figured out what your loan estimate ought to be, review the loan terms of your selected lenders and any other financial obligations to ensure that you can actually afford this. If the loan estimate is more than you can afford, you may want to think about lowering your estimate or look for a different loan option. I mean, those are things that you really should be considering because just because you're getting a loan doesn't mean, yes, I'm in the money. Literally, it's like, well, you got to pay it back at a 25% interest rate. Can you afford that?
You should do some projections. And if you can't do it yourself, definitely work with any account should be able to do a projection for you. You just want to make sure you can cover it too, because you don't want to get that ding.
Right, and comfortably.
Not paying.
Absolutely. You have to think like them. If you were the lender, what would you want to see? What kind of character would you want the person or business you're loaning your money to have? If you start your loan process with the perspective of a loan, of a lender, you will have a higher chance of getting approved. Don't forget that you are beholden to this lender. So if they ask for additional documentation, you better make them number one priority. You've got to get it to them as soon as possible. Imagine that banks and other alternative lenders are likely reviewing a whole lot of loan applications. And a lot of times it's first come, first serve, whether or not they tell you that is, so if you're asking for something, you need to make that your first priority. If you want this money, you need to work for it. If you're going to work for it, you need to be accurate. Commingling accounts, incorrect or inaccurate books, or other bad practices in business are not going to cut it if you're trying to get a loan. I don't care how small it is or how you think, oh, this isn't going to matter. It will matter. At the end of the day, when you are preparing your documents, especially your financial documents, you should be able to determine whether a loan is what you need or if your main issue is cash flow. Are people not paying you on time? Maybe there are some things that you can do to get people to pay you, which of course is another episode. Like maybe the invoice financing isn't something that you can look into, but maybe there's something else going on. You need to dig deeper into that. Your need for a loan may either be reduced, like the amount of money that you need in a loan may be reduced, or you may end up not needing one at all. So it's a good idea to see, is it a you problem or is it a them problem?
It's always a good question to ask when
Yeah.
you're a business owner. Is it a me problem?
Yeah.
Probably.
Yeah. Be honest with yourself.
Well, you bring up an interesting point because I think there is a misconception that, oh, if I go get a loan, I get this infusion of cash and it'll actually alleviate my cash flow problem.
Right.
But a lot of times you have to ask yourself, is your cash flow problem simply created because you're not managing your cash flow?
You're not
problem?
good with money.
Which means even if you get more money and you're still not managing, you're still going to run into the same issue, right? So you're not really solving the basic underlying cause of what's causing you grief.
Is it me?
Yeah.
Am I the
But
drama?
that's so
Yes.
true, right? And that's the one thing nobody wants to hear about is it like, oh, is it me? And not to mention the fact that depending on your size of your loan, if it's a large enough loan, first of all, the bank will find out you don't have a great cash flow
Yes.
management process. And then they're going to probably ding you on it because guess what? If you don't have a great one, which means you're going to run out of cash again, they're not going to get paid back and they're not going to be happy about it.
Nope.
And most lenders are like this, not just banks.
Absolutely.
Yeah.
In the end, a lender is going to want to know who you are as a person, your business is as a business. They want to know that you can repay that loan, what qualifies you, or rather what qualifications you have to pay back said loan. It's a lot about who you are holistically. That's not to say that there aren't some shady lenders out there. So beware of a lender who has higher interest rates than their competitors. There are some private lenders that people use as alternative methods. Now, that's what I was talking about, alternative methods. So if this lender has fees that are maybe 5% of the value of the loan, you may want to walk away. If they ask you to lie on any of your paperwork or just tell you to leave things blank, especially the signature boxes, or if they pressure you into anything, you've got to trust your gut. If you feel a red flag coming on, then stop it right there. They're not the right lender for you. Before you finalize any loan agreement, make sure you consult an attorney, a financial planner, or if you have an accountant, then your accountant, about how much money you need and when you need it. I would say you're probably safe with the bank because they are beholden to the government. But any other kind of lender, you're going to want to have another set of professional eyes on what you're about to sign up for, just so that you make sure you don't get yourself in a worse pickle than you were in before.
Well, yeah. And I mean, even if you do have professionals helping you, like you yourself need to take the time to understand the terms, understand the covenants of these loan documents, and understand what you're signing up for. Right. Even if you go through a bank, I mean, they may be explaining stuff to you. And if you don't understand it, you don't know how to translate that into the impact of the business. So then you're still kind of left. You're still the only one left holding the bag at the end of the day. So you have to understand this stuff and you need to get people to help you understand this.
Right. And so I can't say that I have, I don't know that I have much to add in a point counterpoint, but I can, because I think that we're both on the same page when it comes to how you should prepare. And I don't know that we could even, I don't think that we would disagree on how you should prepare.
Do we ever disagree?
Really? Do we? I don't think but I thought with the raw truth, I can say that myself and probably for you, I have been, I guess not a fly on the wall because I was engaged, but I have seen the pitfalls of people who have tried to garner a loan of some kind, and it hasn't boded well for them.
Yeah.
Or they just really suck at money management.
Yeah.
And I was just talking to Tiffany about a client that I feel I am worried a lot about this client because I worry that their inability to flow their cash appropriately is going to take them out of business, which makes me very, very sad. So, I mean, what would you like to share?
So I would say that it's interesting. Like, I mean, most of my clients weren't this way, but as I was building the business and we were kind of graduating from the client size up to a certain level, for those that are a little bit on the smaller side, meaning maybe like $3 million and under, what I found was a lot more personalities where the owners, I don't know if avoidance is the right word, but tend to well, no, avoidance is the right word, tend to avoid their own financials,
Yeah.
right? Anything financial to do with the business, right? Because, they're living high on the fact that they built this business. Now it's bringing in a couple $1,000,000 a year. Like they must be doing things right. And they don't pay attention to the financials. And they hit a point where they're like, oh, we're like 2, 3 now. We need to get over to the $5 million mark. We're going to go and get some capital infusion or some lending to get more working capital in, and they get stopped short at the bank, and they're surprised because the financials, which maybe even if they have an accountant, they're preparing it, they're just not paying, the owners are not paying attention to it. They present the financials and the bank's like, no, and they're like, what do you mean no, right? Because they just seem to flip a switch and just avoid the subject of financials.
Yes.
Now the larger clients, and when I say larger clients, I think I'm saying more about like the $10 million a year revenue type of clients. They're typically pretty prepared on the business side. I think for them, it gets a little hard because of these personal financial statements, because it goes through and, you have to list all of your assets. You have to list all your personal debt on there too, right? Like you have to list like your mortgage and everything like that. I mean, it's a fairly detailed financial statement report, and it's really unlikely that businesses taking out a large loan for the first time can get away without having a personal guarantee on your loan, especially if you're going through like a traditional lending, right? Like a bank. So, they usually get an obstacle when it comes to the personal financial side of it, because you don't realize how much your personal credit worthiness is on the table when it comes to getting a business loan. So that's always the, I guess, my experience.
Yeah. I think that we've both seen our share of sad situations.
Well, nobody likes to get rejected, I'll tell you that.
No, nobody likes rejection.
Nobody likes rejection.
But you got to be prepared to not get voted off the island.
But, and that's the thing too. And I've seen people who waited till the last minute because they don't process how much legwork this takes, right? The questions and everything like that, right? And then there is questioning because, I mean, the banks aren't stupid. They have underwriters. They're looking at everything with a critical eye. So they question, well, why was it this way? Why is it this way? Are you sure this is the right plan? Are you sure this projection is going to happen? And it's a lot of legwork to prepare.
I think it's a lot similar to buying a house. If you've ever bought a house and you're, as a listener, and you're trying to imagine
the fine print,
it's a lot of work. Just like the kind of work it takes for you to get approved for a mortgage loan. It's very similar to that. So if you can imagine that, or maybe you've never bought a home, but you have a sense of what a mortgage loan process looks like, that's what you're looking at. So be prepared. Be prepared for that.
And then for the cost afterwards, I do know that, like, for certain loans, you get to a certain size. Let's just say that it's a $1 million loan, or even $1 million line, access to $1 million line of credit. You hit a certain size, the bank afterwards wants you to have reviewed or audited financial reports. That costs us a pretty penny. That's not a cheap administrative cost, and it's usually built into the loan docs, right? And then this I've seen kind of spring up on people a little bit. They're like, wait, what do you mean? I have to go hire a CPA firm to come in? And I'm sorry, wait, a review is $30,000.
Yeah.
It always catches everybody by surprise. So there's also a lot of administrative, like, set aside fees and costs that oftentimes isn't calculated in unless you do a projection into the thoughtful projection, and you can make sure that you have this all covered.
Yep. So from here, we are going to move on to our famous example. In each episode, we like to connect a famous example to our discussion to help you relate our talking points on a more global or well-recognized scale, revealing the dots between the living room startup and the success story on the cover of Forbes. Sometimes we use exact examples of either famous persons or successful business owners of today or in history, and sometimes we use examples of people who inspire us and have inspired today's discussion. I think this might be the first time that I got nothing.
I did my homework.
Yeah. I mean, truth be told,
mind you, it was at 6 a.m. this morning, but hey.
Truth be told, I had some I had some fires.
Fires, yeah.
So I just
hear
didn't
ya.
have the time. I'm sorry, everybody.
That's okay.
But Tiffany,
That's why I got you.
yeah, man.
Yeah.
I got you, babe. All right, so take it away, Tiffany.
All right. So today's example is actually someone kind of local to us, which is
Ooh.
kind of cool. So Kevin Plank. So he is, well, I don't know for people who don't. I'll get to what he does, right? So in the 1990s, Kevin Plank, he was a University of Maryland football player. And he felt like there was a need in the market for this moisture wicking apparel that can help athletes stay dry and improve their performance during intensive workouts. And then from the basement of his grandmother's townhouse, he started developing prototypes for a new type of t-shirts. And then what happens is he ended up maxing out all his credit cards to fund this little endeavor of his. And he knew he needed more financing to take it to the next level. So in 1995, he took out an SBA loan of $250,000. And because of this loan, the business, it kind of propelled, it was like the starting point of getting the business to where it was today. It's this little company called Under Armour.
Yeah, it's going places.
Tiny little thing. Tiny. So small.
At that time, he went by a different name, and I can't remember what it was. I just remember
he did. Oh my gosh, I forgot what his original name. You should Google that. Yeah, now I'm curious.
At the
he
time,
had another name before Under Armour,
and I'm like, oh, thank you for changing that.
It was not a great name. It was definitely yeah. So you look that up. Yeah. And then so basically what he did is he took his SBA loan of $250K and he was able to use that to do a couple things. One, he did a huge marketing push. So then he used the funds to basically send out samples of his product to colleges and NFL teams, targeting these equipment managers and to the players directly. And then he also invested in a half-page ad in ESPN, the magazine, which then ended up generating over $1 million in direct sales. The second thing he did was more of a strategic production where he took the loan and he ramped up production of his product, ensuring that the demand could be met once the awareness from his marketing push helped the product grow. And then from that, of course, they were able to grow and they were able to expand. Then they eventually diversified the product line beyond these t-shirts. And now they have footwear and all those great things that we go see in the stores. Yeah.
So I found the funny reason behind the name, and this is on businessinsider.com, and we'll put it in the show notes so you can read the full article. He initially wanted to call the company Heart, as in wearing your heart on your sleeve, but he couldn't get a trademark for that. Then his next idea was Body Armor, a name that he had fallen in love with. But when the clearing process for the trademark was 2 weeks late.
He couldn't get it, or
he was denied.
Yeah, because that's very general.
He apparently had lunch plans that afternoon with his oldest brother, and when he goes to show up, he goes to pick up his brother. His brother goes, "How's that company you're working on? Under Armour?"
That Under Armour thing. He's like, "That's a great name."
So he doesn't know if his brother was messing with him or if it was just something, but it clicked. And he decided to go with the British.
I was going to ask if they said why the British spelling on armor.
We added the U because I was skeptical at the time about whether this whole internet thing would stick.
It was the 90s, guys. The internet was just a thing back then.
So I thought the phone number 888-4-ARMOR with a U was much more compelling than 888-44-ARMOR. Yeah, I wish there was a little more science, but it was that simple.
I love it, though. That is such a good story.
So yes, there's more to this story about him and Under Armour, and we'll put it in the show notes.
That's awesome. Make sure you send me that link, so we'll make sure we pop it in there. But see, that's so much fun. See, we did the story together.
I had something to add. Yay!
But that's a real life case of that SBA loan coming through, and I'm sure if you haven't thought about applying for an SBA loan, take a look.
Yeah.
I mean, it is there set aside by the government to help fund small businesses.
Yeah. You never know what you're going to get until you try. All right. So there's a saying that goes, put your money where your mouth is. And we're drilling down a bit further here to connect what we've discussed at a granular level to tangible sources you can take to get you to that next level.
So 3 things on my end. one, keep track of your business credit score just like you do your personal credit score, right? So I think a lot more people are much more aware of how to keep up with their personal credit score because, you just log into like Experian, what's the other one?
Credit Karma?
Yeah, that too, right? But like, what's the 3 credit bureaus?
Oh, Equifax,
Experian, and
Union.
TransUnion. Thank you. So those 3, right? And those are really easy. You log in and then you get yourself set up and then you can kind of see your score there and then. Now, the 3 major credit bureaus for business is actually Dun & Bradstreet, Equifax, and Experian. And as you would imagine, for a business credit report, it's not a free thing. So you actually do have to pay to be able to pull that out. But it's good to know because what affects your business credit score is not the same as what affects your personal credit score, right? So if you think, hey, I'm going to go out there and just get a business credit card and we start putting everything on a credit card so I can pay that off and then that's going to be good for my score. One, not every business credit card reports to the credit bureau.
Yeah, right.
Anybody knew that, right? Like I just learned that fact recently. I was like, wait, what do you mean it's not automatic? It's not automatic. And 2, like I said, some stuff, it's not all just credit. Like it's not all just finance when it comes to business credit score. There are other things involved. So highly recommend that you take a look at any of those 3 credit bureaus and they have educational stuff on there for you to understand what impacts your credit score, your business credit score, for you to keep track of it. And I think pulling a report is like $40 or something like that.
Which is worth it.
Do that every once in a while just to keep an eye on it and make sure that you have that ready before you walk in and ask for a loan. At least you have that side cover alongside your personal credit score. And the lights just, there you go.
Hallelujah.
Must have said something right. The other thing I would say is, if you're a newer business owner, if you're somebody who comes from a history or family or just a habit of not having a lot of debt, and this is kind of new to you all, then, a great thing you can do is form a good relationship with one of your community banker, like a banker at a community bank, because they're so great to work with. They're a lot more in person, one-on-one. And, they'll oftentimes walk you through this. So maybe you're not ready today, but you think you might be ready in a year from now. You can certainly start establishing that relationship. Ask them to take a look at what you have today, and then they'll help point you in the right direction of maybe this needs to be a little higher, this needs to look a little better, and things like that. So you can learn a lot from that process too. So so I'm a fan of the community banks in our area. I think they're great for small business.
Absolutely.
Now, the last thing is, Savannah's going to love this.
It's probably going to be the same thing I'm going to say.
Hire a bookkeeper.
It is the same thing as I'm going to say.
Hire the right bookkeeping and accounting support. If you can't afford an accountant, then level up your own knowledge on how to read financials and review them regularly as your bookkeeper provides them to you. Now, if you don't look forward to reviewing and reading and understanding your financial reports once a month, then I would say this. Set yourself up with a reoccurring calendar appointment for you, yourself, and you in your financial reports. Cajole yourself with some coffee, with some pastry, with some sandwiches, with a glass of bourbon, whatever. Pick your choice and make yourself do it once a month.
Yes, I agree.
And look at it from a very critical point of view, right? If you were somebody who was going to lend money to this company on this piece that, the story is being told on this piece of paper, what would you see? Would you lend them money? How strong do you think this company is? Do it for yourself.
Yeah, the best thing you can do is be honest with yourself. And I can't say that, maybe there are some books out there that could help you, but really this is going to take a matter of you making an investment in your own knowledge.
Yeah.
And if you haven't invested in a bookkeeper, as you said, then now is the time to do it. And if you can't afford it, or if you think you can't afford it, I'd say see if you can find a bookkeeper or a bookkeeping firm that can maybe review your financials on a quarterly basis. Maybe they can charge you for that, and maybe you could just pay for that, or an accountant who could just review what you've got and tell you what you did wrong or whatever it is. I don't know. But, you know your own
Here's
budget.
a hint. If it's negative, take a look at it twice.
Exactly. If you don't already have a format or a platform on which to do your financials on, don't do it on a spreadsheet because it's not going to
unless you know how double-sided entries work.
You're not
do
gonna,
it on Excel.
Don't do it on Excel. You can do it on QuickBooks. I do think that QuickBooks is the great thing about QuickBooks is that it's very user friendly and it keeps things in very layman terms. So a bookkeeper can use it on our end to do the financials, but you as a client on the other end won't have as much of a problem to understand what those financials are. And as Tiffany said, if you don't know the terminology or aren't as familiar with terminology, I would say stay tuned because
wait. Are we going on to the next section?
we're about to.
Okay, really quickly though, just one thing to add is don't forget to look at your tax returns.
Oh, yeah.
Right, your business tax returns. Make sure that those make sense to you, and they better align to your financial statement because that's the first thing any lender is going to snuff out. They'll be looking at these and they're like, "Well, why is you reported this much income? I don't see this on this end." I agree. That's a problem. There's a reason why accounts don't like to go in the past and change things because things like that.
Yes.
Right. But that's important. Like those little things. And again, if you don't understand your own returns, like I'm being serious. I know that it sucks to read the form. I hate reading the forms, whatever. Right. But you kind of need to know it. Right. So make sure you understand what's in your business tax returns and what is that saying.
Yes. Agreed.
And find a nice accountant to help you.
Yeah, I'm sure you could find someone in your area. And we're very fortunate here in Fairfax County because there are so many great opportunities for business owners that are free. Like there's the SBDC, there's the Community Business Partnership. If not free, then at a very low cost.
Educational, right? And then plus coaching, like free advice and free coaching.
Coaching and workshops and things like that you could go to if just to brush up.
Yeah, your local EDA, economic development.
Exactly.
Yeah,
exactly.
Same
So
thing.
there's a lot of opportunities. You just have to look for them because no county or city wants you to go out of business.
They want you to do well.
They want you to do well because the better you do, the better the economy of that area does. So,
and our government wants you to do well. The better you do, the more taxes you pay.
The more taxes you pay.
What do you know?
Yeah. So, in saying that, we are going to. Next episode is going to be about exploring a little bit deeper into loan, grant, and aid options. And this is going to be a series of us. But after this series, I do want to kind of announce, if you will, that we're going to be re-recording.
I was like, what are we announcing?
Not announcing. Maybe a heads up. Maybe a heads up is more of it. But we're going to do some re-records because we recognize that we have a broader audience now. We also have a little bit better recording opportunity. Yeah. So we're a little bit better at this now. And looking back, we did.
I like how you say it's not like we're wiser, apparently. Just our stuff. Do we just use better words?
Maybe.
We have better mics right now, which is about to improve too, right?
Yeah.
So we're getting better at everything, and we figured it was worth because we had a lot of really good topics.
The first season was great, full of wonderful topics.
Okay, well, first of all, do not go back and. Well, now that I say this, now everybody's going to try to go back and look at the first season. Like, don't. We're going to redo all of it.
Yes.
And it's not going to be a word for word thing. Like, we're basically going to kind of
revamp them.
Revamp.
Yeah, we're going to revamp them because we did have some really, really good things.
Yeah.
That are also pertinent to what we're talking about right now and then what's coming up in the future. So we're going to. I don't know that we're going to do all of them. Maybe we haven't really decided, but definitely the most important ones. Because we had quite a few shows that were chock full of information.
It was. I just also looked like I was like stage fright, you know. Or they sound. I guess we weren't on video, so I sounded like I had stage fright because every time that mic turned on, I'm like, I can't talk. I can't use my words anymore.
Yeah, so we want to continue to bring you really good, a really good product and great information. And we recognize that maybe our first season we had great information, just not great ways in which to present them to you. So we are going to bring some of those back, and rehash them and re-record them and share the additional knowledge that we have gained.
She's just saying that to make me happy.
I mean, I'm kind of hoping that I've gotten smarter too.
You think so?
I don't think I have.
I don't know. I'm just saying you probably have. I don't know. There are days I'm like.
The more I learn, the more I realize how little I know. You can quote that.
Okay.
Put it on it. Put it on a t-shirt.
Okay, so expect season 1 2.0. Season 1 2. Yeah. 2.0 version of season 1.
In our third season. Is that confusing?
Yeah, I'm still working on the words part.
as we close our third season, and we're gonna bring some more to the table as we get into our fourth season as well.
Watch us grow.
I can't believe it's gonna be 4 seasons. Jeez. And we still like each other. Like, how
That
cool
is true. That's right. We actually end up spending more time as time goes on.
I know. And we want you to know that we put a lot into these shows, although sometimes it seems like I'm completely unprepared. But
it's only because in our normal businesses, like, things happen.
Yeah,
right?
we're still
like,
running full-time
shit happens,
businesses.
right?
Yes.
And
absolutely.
so there are days where you have a fire to put out in the morning, and I'm up at like 5, 6 a.m. going, oh crap, I gotta put some time to this and figure this out before we have to record. So sometimes it feels that way, but typically, I mean, there's a lot of thinking and researching and thoughts and planning and all the stuff that goes into it. So,
and we text each other, and we call each other, and we email each other in between shows, and we talk about all these other things that we could be.
A couple of Fridays ago, I almost just moved into her place.
I was about to charge rent.
Yeah, we were there that long.
Yeah, but it's the thing is that sometimes we do these shows, and it creates an after discussion for us too. But we want it to be something that you can join in on. So please show us your support by following us, not just on your preferred podcast platform, social media, and also on YouTube, but please consider being a sponsor to our show, a producer for our show. And if there are things that you want to learn more about, please email us at thebusinessbehindSmallBusiness@gmail.com. If you have comments, if you have questions, we will give your name in we will give your name a shout out for whatever it is, however way in which you want us to shout you out, if it's by like your username or something like that. And then we can make it a little bit more interactive because, yes, we do talk to each other, but we're giving you information based on our perspectives, our research, and whatnot. Maybe you have a real world issue that we haven't touched yet.
And maybe we can solve it for you on air.
Absolutely. So till next time, mind the business behind your business, because all great successes start small.